Professor Vasvari, Florin, it's such an honor to have you here, to have this interview with you. Can you briefly introduce yourself? Who are you? What's your area of expertise?
Thanks for having me. So my name is Florin Vasvari. I'm a professor at London Business School, where I'm also the academic director of the Institute of Entrepreneurship and Private Capital. I teach private equity and venture capital. At the moment, one of the most successful finance electives within the school. I also teach another class on distressed investing. So I kind of focus on investments in the alternative space, private markets mainly.
Mm-hmm. We're going to talk about private markets in this interview.
A lot.
Yeah. So family offices, you also know them very well. They disproportionately invest in private assets compared to institutional investors who are typically much more cautious, prefer to invest in quoted stocks, bonds, whatever.
Yeah.
Do you think that they are right, or should they follow their peers? Should they follow the professional institutional investors and limit their exposure to private markets?
I mean, I think we need to start by thinking how the family offices have emerged. A lot of them have been built on liquidity events when the families have sold their family businesses. And to some extent, these are the people that were operators, running businesses, end up with a lot of liquidity, and now they have to become investors. And of course, it is natural for them to gravitate towards the areas that they are familiar with. And usually they start from a private business type background. So they end up investing in the same area. Some of them continue to own family businesses, and they use the family office as a way of diversifying their wealth. And not surprisingly, when they allocate the capital, they're thinking about synergies with their family business. As a result, they gravitate towards private businesses. But interestingly enough, we have a very interesting trend. If you look at the institutional, sophisticated, as you call them, investors out there that invest more in the public markets, traditionally they used to invest just in public markets. They used to put 60, 70% of the capital in public equities, and then 30, 40% in fixed income, in bonds usually. That's the traditional, let's say, portfolio allocation that they used to follow. And that was many years ago. But today, those very investors are shifting into private markets. So to some extent, they are converging towards what family offices are doing, right? And if you look at some very sophisticated investors out there, institutional investors, maybe a good example would be to look at the endowments of very large universities in the United States. If you look at Harvard or Yale and their endowment, how they allocate the capital, well, close to 50% of that is in private markets, alternative assets. And I would say that they are the pallbearers in that area, because they are the ones that have pushed the most investments in private markets, because they understood that by investing in private markets, you match your horizon. Their horizon is very long, 30 years ahead. And they're not worried about the illiquidity of private markets. They worry about the alpha or the extra return that they get in that market. And they're willing to bear the illiquidity in exchange for that additional return, given their long-term horizon. So a lot of institutional investors, in particular very large pension funds, are reconsidering those traditional portfolios, and they're shifting more of their assets into private markets. So in a way, the trend is, can they do more of what the family offices are doing? That being said, there's a huge variation of family offices out there, right? There are those very small ones and unsophisticated, to the very, very sophisticated ones that manage billions of dollars in assets. So depending on that level of sophistication, you'll have more or less allocated into private markets.
Okay, interesting. But you rightly say that many family offices have a very entrepreneurial background, running their family firm, very often haven't started their own companies. Now, investing in other companies, that's a different job.
It's a different ball game, yeah.
Yeah. So how can successful entrepreneurs, successful managers, successful family business owners, how can they become successful investors as well?
Yeah, well, there are many models out there. First of all, if the knowledge or the skills are not there, it can always be brought in, right? So they can acquire talent, they can hire the right talent to work in the family office. And in fact, if you look at the best run family offices, it is those family offices that are run by professionals, not by family members, okay? Family members take usually a more non-executive role. They might be the ultimate decision makers on very big decisions on capital allocation, but the day-to-day investment activities are often run by professional chief investment officers who often come from that institutionalized sector that has been investing in private equity for a long time. So one way is to acquire talent. A second way to avoid mistakes is to actually partner with like-minded investors. And that means partnering with more sophisticated family offices that have been through this journey many years before, and they learned how to invest in private markets, or partnering with private equity funds themselves to acquire companies or invest in companies and providing, call it passive capital on those investments. So still allowing the fund managers to lead the deals, source the deals, do the due diligence, and run those companies. But then the family offices provide just the co-investment with those fund managers. And to some extent, this type of collaboration is also used to optimize on fees. One way to invest in private markets is to totally outsource the process to a fund manager. Say, here's my capital, put it in your fund, and you invest, you run these businesses. But of course, in exchange for that, you need to pay fees as an investor. Now the family offices are moving into, here's some of our capital, but also this other piece of capital, we want this to stay outside the fund, and we want to co-invest with you, and on that co-investment, we don't want to pay fees. So,
and is it a good idea to co-invest? Because you might think that private equity investors only would want to offload their lemons.
Yes, yeah, I see what you're saying. Yeah. And actually, it's a very valid point.
Companies.
It's a very valid point, and people have looked at that to understand whether co-investments are performing as well as the main funds to which they are attached. And the evidence is pretty clear. They are not underperforming the funds. And in fact, they outperform the funds. And the reason why they outperform is mainly driven by the fact that they don't incur any fees. So in other words, the average deal that is offered for a co-investment is indistinguishable from the average deal in a fund.
It's not the worst deals that are
It's not the worst
offloaded.
deals. Yeah. By the way, the investors that put money into these funds and are offered co-investment opportunities, they can always say no to those. And they often say no if those opportunities don't fit their taste or their portfolio. So it's not given that they will have to take them. They can always say no. So the fund managers, I think they're doing their best to provide the best opportunities. In a way, if you think what is offered for co-investments is typically the deals that break the investment limits of a fund. Just to give you a very basic example, if you have a $100 fund that has limits of only 10% investment limit to any individual company, so that means a fund can only invest $10 in an individual company, but here comes an opportunity that requires $15. That difference between 15 and 10 is a co-investment that comes from a co-investor. And the fact that the deal is bigger than the average deal in the fund doesn't mean that it's going to be worse. If anything, they try to be opportunistic.
Okay, clear. Now, family offices, when they consider entering the private equity space, they might also go through fund of funds.
Yes.
What's your view on that?
Yeah,
Because
yeah.
that's fees on fees.
That's right.
Intuitively, it doesn't sound appealing.
It
So
doesn't.
why do they exist?
But there is a learning curve. As you rightly said at the beginning, investing in private markets is not straightforward. It's not straightforward because one needs to be able to access deals. And in the private opaque market, those deals are often not available. If you don't have a reputation in the market, if people don't know you, it's not clear why they would offer you the best deals. So it's not easy to access those deals. And second, you need to have the ability to structure those deals. It's complicated. Then finally, you need to be able to run those companies. And maybe they're in sectors that you're not familiar with. So how would you do that? So there's a learning curve. If you're at the very beginning of the investment process in private markets, if you're getting started, probably the safest way is to go through funds of funds.
And
right?
why would that then be? What are the advantages?
The advantage is that you are going to pay fees for that, but one might make a very simple economic calculation and figure out that the fees that you pay are still lower than the cost that you would incur if you were to build that investment team yourself in-house. Mm-hmm. And it's a function of the amount of capital that you are allocating. Mm-hmm. Just to give you another example, if you want to allocate, let's say, 20 million in private equity, one would argue that the amount is small. You can't really diversify enough with 20 million. Mm-hmm. Some funds have a minimum limit of 5 million. So with 20 million, you can only invest in 4 private equity funds. Then the question is, which 4 funds would you invest in? There are thousands of them available. So you need an investment team to hire people to figure out for you who are those fund managers that raise these 4 funds to invest in. And then you need to deal with them, you need to monitor them, you need to deal with their reporting and so on. That's a cost.
Okay.
The alternative is not to hire this team, go to fund of funds, pay an extra fee, which is usually a percentage of that 20 million. It's a fixed fee, typically is 1 or 2% of that. And that 1-2% might be smaller than hiring all these people. Mm-hmm. And in addition, it allows you to diversify significantly. Because putting 20 million in a fund of funds means that your capital will be allocated to at least 30 funds. Right? So it's a trade-off analysis. Now, if you have to allocate $1 billion in private equity, then it's probably better to build your own team and not pay those fees because you'll be better off. Yes. So there's an element of trading off the costs and benefits. But also people use fund of funds as a way to learning their way into private equity without taking excessive risks. Once you understand what's happening, then maybe you start allocating yourselves to funds. So we call it primaries, where you you identify yourself, the fund managers and the funds, and you invest yourself in those. So obviously you're not going to pay the fund of fund fees.
Yeah. And in that kind of activities, when they directly invest in funds, how should they select the best funds? Because there's a wide disparity in returns.
Yeah.
So picking the winners is really important.
Yes.
How can you pick the winners? What's the magic sauce?
It's very difficult. It's very difficult to explain that. I mean, at London Business School, I teach a class on private equity investing. It's called the Private Equity Master Class. We teach that to executives and investors in the market over a period of 4 days. And I think we spent 2 full days to take people through the process of what we call fund due diligence, which is how you select the fund managers. At the high level, the framework involves analyzing the strategy of the fund, what this fund manager is doing and how they're doing it differently from their competitors. The second element of analysis is understanding the team. Who is working for that fund manager? What is their capacity, expertise, experience in that particular market? The third level of analysis is to understand what are the economics of the fund in terms of fees and other terms that you are offered, because a private equity fund is a financial product. understanding also the organization of the firm. People care a lot about operational due diligence, understanding whether my data is going to be protected, cybersecurity risk, compliance, HR policies, paying the IT licenses, and the risk goes on and on.
It's like doing the due diligence on an individual single portfolio company.
Yes, exactly. Yeah. So there is what we call investment due diligence, where you assess people's ability to allocate your capital, but also operational due diligence, understanding whether these people are set up appropriately to allocate your capital. So it's the non-investment risk, I would say. Now, the fourth element of the analysis is the track record of the individuals involved. So at London Business School, we spend a lot of time trying to dig very deep into these 4 dimensions. And of course, looking at a lot of data and benchmarking the performance of various funds. And it's not a science, unfortunately.
Otherwise, it would be easy to pick.
Yes, it would be very easy.
It was just a magic formula.
But let me put it this way. When investors decide to allocate capital to private markets, it's a mindset change. If you have $1 billion and you want to invest in public markets, you can invest it in 1 minute. You can buy some indices, buy some very big stock, and 1 minute you allocate $1 billion. To allocate $1 billion in a private market, it takes many, many years. Because you need to find managers. The managers are not going to call your capital right away. By the time your capital is called, maybe some other investments are being distributed back to you. It's not easy to spend $1 billion in this market. It takes many years.
And is it worth it in the end?
Well, historically, the returns are showing that the private equity funds, at least the average private equity fund, has done relatively well, double-digit returns. Of course, there's a lot of variation, and there are lots of strategies within the private capital market. So different types of funds, as you know, you have venture funds, growth funds, buyout funds, special situation funds, each of them with their strategies, each of them with their geographical focus, and sometimes with sectorial focus. So there's a huge diversity of strategies out there. And of course, different strategies are going to do better or worse depending on the conditions. Right? But on average, if you look at the average performance of a private equity fund, it has been double digit.
I would like to look into your crystal ball. I hope you have one. After
I
the
wish.
huge increase in values and returns in the previous decade, we're now going to a dip. Is it temporary? How do you see the future?
If you think about how investors allocate capital in the financial market, the biggest driver of capital allocations is past performance, immediate past performance, I would call it. In other words, a lot of investors out there are chasing recent returns. That happens in the public market. When a stock price goes up, more people notice it and they start buying even more, bidding up the price, potentially overvaluing the company. To some extent, it also happens in the private equity market, right? So people see good returns, let's say in venture capital, they started putting more money into venture funds. And then interest rates went up in 2022 and 2023. These funds didn't do very well, or at least they're struggling with exits, right? I would argue that if you're an investor in the private market, you want to be counter-cyclical, if you want. You want to be a contrarian investor. It is during these times that you should invest, not during the good times, right? During these times when it's more difficult maybe to raise capital, there might be more opportunities right now in the market, right? And I think traditionally, if you look at the performance of the funds, we try to look at the performance of the private equity funds based on their vintages. So vintages that are during a crisis or immediately after tend to do much better than vintages just before the crisis starts. So if you look at funds maybe in 2006, 2005, 2007, on average, I think they have done worse than the funds in 2009, 2010, 2011, right? So when people get scared, the money pulls out. But that's exactly when you shouldn't pull the money out. So, but it's very difficult for investors. I mean, it's very easy to talk in theory about having the contrarian mindset. Implementing it in practice is much harder because the reality is that people are given a mandate to allocate capital. Whether the times are good or bad, they need to allocate it, right? So it's not easy to time it.
Okay. Anything else? Any important message that you still want to bring to our family offices?
I mean, I think investing in private markets is a huge opportunity. And the main advantage, you know, I've been teaching private equity at London Business School for many years. And we have launched at London Business School even programs on family offices. And I got to interact with a lot of them. And my thinking has evolved over time because I believe that family offices have a big advantage, in fact, over private equity funds, to the extent that they can replicate the investment strategies of private equity fund managers. They can be very successful because they have more patient capital than private equity funds. They don't need to raise the capital. If you think about the hats that a private equity fund manager needs to wear, first they need to be a very good salesman to fundraise. Then they need to source deals. Then they need to manage these deals. Then they need to exit. And then they need to start fundraising all over again. If you're in a family office, you don't need to wear all those. You can actually focus just on the investment and value creation process. Capital is already there, and you don't have the pressure to exit. And sometimes, by not exiting, you actually compound the value over longer periods of time, and that can be very, very successful. Because to some extent, when private equity funds buy and sell companies, a lot of that value generated leaks out through these transaction costs. In the private market, transaction costs are very high. Legal fees, accounting fees, due diligence costs, and all these things. By not having to buy and sell companies so often, a family office can actually economize on this and actually compound the value in the long term without the pressure of exiting. And I think that's a very big advantage, that potentially some of them are actually making a lot of direct investments, competing head to head with the private equity funds they used to invest in, which is interesting. So you invest in a private equity fund, then you co-invest with the private equity fund, you learn what they're doing, and then you just do it yourself, right? And then at that point, you don't pay any fees anymore, right?
Okay.
The question is whether you have the internal skill set to do what they do. And I think what the family offices need to work on a little bit is on the incentive scheme. Because in private equity, the carried interest, the 20% of profits, and the natural exits of companies align very well their incentives and their horizons with those of those investors.
So the best talents would rather go to a private equity firm rather than to a family office?
Potentially, but if a family office can replicate that incentive structure, even if you don't exit a company, you can still compute synthetic carry, right? Without exiting a company and still compensate people handsomely for generating value. To the extent that you can do that, and some people do it very well, then I don't see any difference. You can still attract the talent. And in fact, the talent might be more likely to work with you because most of these individuals that like investing, they usually don't enjoy the process of fundraising.
Okay.
Usually. Depends on the person, of course. But if they focus on the craft they know best and they enjoy, they will probably be happier.
Okay. Thanks a lot. Thanks a lot for your insights. It's a very positive story, but the marriage between family offices and private capital.
Yeah. And the family offices today, depends on the data. It's not readily available, but it was estimated to be at about 8 trillion. And that's not far from the entire private equity fund industry, which is about the same, right? So
you should not ignore them.
Definitely not. Definitely not.
Okay.
And they're growing bigger. I think there are over 10,000 family offices out there, getting bigger and bigger.
Thanks a lot.
Thank you so much for your time.
Highly insightful, very interesting.
Thank you.
Yeah.
Thank you.